Good morning. My name is Shirley Lou. I am your host for today, Focus in Finance. And you know what? I tell you, this can be one of my favorite episodes you're listening in. So it's interesting. I had a client coming in and he said, I have money in a retirement account, and I'm very concerned about the laws and all that stuff, but I love the gains. And he said, but you know what could even be better? How about getting it tax-free? I said, oh, so you want everything. You want it grows, you want it to grow tax-deferred, and you want it to become, when you take the money out, tax-free and all that. He said, yeah, wouldn't it be cool? Because I know for a fact that in my retirement account today, when I take it out, I'm going to get hit with taxes on that. And I said, well, that's the deal that you made, so that's the deal you have to pay. But he said, but can I make more money and that I don't have to pay taxes on that more money in my account? I said, so you mean to tell me, like, if you gave me $200,000 and 10 years down the road, it becomes $800,000, that extra $600,000, you don't have to pay the IRS the money? He go, oh, wouldn't that be cool? I said, what if I told you I could make that dreams come true? Like, you're out there, you probably think, what in the heck are you talking about? That you can make this $600,000 gain on a $200,000 investment down the road. It could be $800,000, it could be $500,000. I'm just saying that any account on this account, when it grows, we can make it become tax-free. Now, how many of you know that it exists? I don't know. How many of you do know? So, in the month of August, I kept talking about the fixed index annuity and things like that. So I want to dedicate this episode to what's called the Fixed FIA ASAP. It's my book that just came out about a month and a half ago that you now can get it on Amazon. And the interesting about this book is let's talk about how do you get the money growth and then it's tax-free 100%. It's something I very seldom talk about, but I'm going to talk about it today on air so for you all can hear and understand. So here's what they call it. They call it what's called, the first thing is that for those of you who wants to have tax-deferred, there's an account called Roth, R-O-T-H, okay? I'll lay it out very slowly, okay? For someone brand new, young ladies, young men out there, anyone that want to start a Roth account, depends on your age. So let's say if you're a little bit over 50, you can put up to $8,600 per year into a Roth account today. And the minute you open that Roth account today, it takes 5 years for it to become tax deferred. Well, the whole thing is being tax deferred, growing on compounded interest, and after 5 years, that $8,600 becomes tax-free 100%. Because we're putting in there, it's called after-tax money. That's why, and if it's a Roth, the rules is you got to have at least 5 years before that becomes tax-free. You understand? The minute you convert that into a Roth at that time or put it in, that's where the time start ticking. So next year, you do another $8,600. Again, next year, 5 years from there, that's when it begins to get tax advantages, tax-free when you take the money out. And here's the beautiful about that Roth as well. There are no requirement minimum distribution, unlike the regular traditional retirement plan. You don't have to abide by the rules. You can take it out if you need to, or you don't have to. So now I just share with you very dumbed down with a Roth. Now the Roth also comes in 3 different flavors. I'll recap it again. One account, someone may say, I want growth only. Carlos said, I want growth only. Okay? Then I got another person, Betty said, no, you know what, I like to have guaranteed income. Then you're going to put that Roth into an income stream down the road. That means you're going to create an account called a Roth income account. And again, after 5 years or so, all the money that's getting out as a stream of income forever to 115 years old, that becomes tax-free 100%. Imagine you're getting like a pension plan and you're not having to pay one dime in taxes. That is really cool. And the money's still growing, right, at that time. So these are the different kind of, account that you can have. Or again, you may say, can I have the growth? But I don't plan to touch this Roth account to 10 years from now, and then I want to start income. Then you can do that third account as well. Again, they have so many different flavors that you can do. Now that's regular folks who happens to have it. I tell you, every single person out there, if you can qualify for income to get a Roth, highly recommended, guy. I don't know why people don't do it. It is one of the greatest vehicles. So that's an outside plan. That's an outside plan where an individual can have it. Young ladies, young men, anyone out there, even 40, 50 years old, have the daggone Roth if you could kind of do that. So that's the first option. Second option is that for those of you who currently go to work, and most of people that I've talked to, they have a Roth inside the 401k. But you know what? Most not even participating. And I'm sitting thinking, why are you not participating when it's one of the greatest vehicles? You know how you go to work, if a company gives you free money, they give you matching money, 3%, 5%, 10%, whatever. Get the free money. While you get the free money that they're giving you, but under condition that you have to contribute, right? So if your contribution is going to be, let's say $500 a paycheck, then take that $500 inside of your 401k or your IRA that you have at work and tell them, said, look, I like all my contribution that I'm putting out to put it inside a Roth. Here's why. You have a 401k, intention is for you to grow that money down the road, you take it out, right? But it's going to be taxable. Well, imagine you have a Roth inside your 401k, grow tax-deferred, compounded interest, and it becomes tax-free. If you're 30 years old, 40 years old, you're working there, and can you imagine over the years how much that can be done? It's huge, huge. Look, I've gained nothing by telling you this about your 401k, because putting part of it inside the Roth, okay? I'm just sharing with you as an advisor, consultant, sharing with you wealth strategy. I'm giving you free advice on that. Pick up the phone, call your human resources, call the fund manager, whoever you have, and said, hey, do we have a Roth feature inside of our retirement plan? Whether it's a 401k, a 403b, or 457 plan, any of those, you are now in position to be able to do that. You understand? Find that out. You've got nothing to lose. Now, I'm going to talk a little bit about Roth conversion. So I had a client coming in and he said to me, Shirley, I've got $200,000. I'm retiring, but I don't need to touch the money. But how do I get this thing, have the growth that I need to, and that I don't have to pay the taxes? So we did a hypothetical illustration. And we said, okay, on $200,000 down the road, if you made $800,000 or $500,000, it doesn't, you want all that to be tax-free. And he said, yeah, guess what? This is how you do it, okay? They call it the Roth conversion. And the way we work the Roth conversion is this. So let's say Carlos has $200,000, and I say, hey, Carlos, you want the money to grow tax-deferred, compounded interest, tax-free? I'm going to give you a different option. You choose, my friend. The first option is that because it was sitting in a retirement account, the IRS is going to force you to pay the taxes, because you can't get away. If it's sitting in a qualified plan, they want that money. But what we can do is we can lessen burden of the taxes. So how do we do that? So let's say $200,000 Roth conversion. When you do a Roth conversion, you could be any age. And if you still keep it in a retirement account, the IRS will not hit you with a penalty. Let me repeat. You could be 40 years old, have $100,000 in a 401k, and if I do a Roth conversion on that, the IRS will not hit you with a 10% penalty. Okay? A lot of misconception out there. People think, oh, I convert this thing, I'm going to hit with a penalty. No, you do not. The IRS say, you know what, since you're keeping it as a retirement still, I'm going to let you have a tax break on that. I won't hit you with a penalty. However, you're going to have to pay the taxes on it, right? So let's say you get hit with the taxes. Let's say 20% on 200K. 2 times 4 is 40,000. That's a pretty steep bill, right? And you're going to say, oh my God, I don't have 40,000 to pay. I love the conversion, but I don't have 40,000 to pay right now. So one option for those who have, 20, 40,000, they can liquidate out the investment account, pay up to IRS one time, and that's it. You're done owing the IRS some money. So let's say 200,000, 40,000 in the taxes. That means you're netting 160. Follow me so far? It's very simple math. 200 minus 40, 160,000. And so one of my clients was like yelling, screaming, oh, 40,000 is too much. And I said, how about this? Let's do a little less. What if I told you their account that gives you bonus on the money, right? So, hey, Carlos, there's this account that's going to give you maybe a 14% bonus. 14% bonus on a $200,000, guess what? That's $28,000. What if we give you $28,000 back in your account? So, 200K, we just added 28,000. Now you have 228. Just kind of consider that as like your money kind of help offset paying to Uncle Sam a little bit. That's pretty neat. When a company out there, you know, and now, so technically, okay, if I pay 40,000 in taxes, technically I got 28,000 back in my account. 40 minus 28. How much is that, right? So you're looking at almost about $12,000 difference in taxes, guys. Do you understand? And that means you're done. Callers no longer have to worry about with IRS. The money's going tax deferred, compounded interest, and he's done. There are so many nifty ways of doing this. That's one way. Or a second way where he said, okay, Shirley, how about this? Let's do it Roth conversion slowly. Okay, so instead of paying tax on 200K now, we'll take only 50,000, callers. You just pay the tax on the 50,000 this year. Next year, we'll pay the tax again on the other 50,000. You see what we're doing here? We're doing it as slowly, what's called Roth conversion. The minute you do this Roth conversion over, it becomes tax deferred compounded interest, but the starting point again at that point in time. Well, guess what? Once I convert this thing down the road, if that can grow to be 100, 2, 3, 4, 5, 6, 7, 8, it does not care. That money is his, tax-free 100%. He doesn't have to take RMD if he doesn't want to, or if he wants to, he could. If he wants to start a lifetime income, he could. If he doesn't want to, he doesn't have to. He can leave for growth if he wants to, or we can take, at that time, how about this? Take that money as lifetime income, and I'm going to create another retirement plan for your family. We take that money, we create several other accounts. Tune in for the next episode. Again, this is Shirley Lou. Remember, we rise by uplifting others.